we approach the end of 2025, let's get a market recap of the year and a look ahead as well on what we can expect for 2026 and what our guest is watching for. We're joined by Nicholas Mersch, portfolio manager at Purpose Investments. Nicholas, thanks very much for joining us.
Thanks so much for having me.
All right, let's look back first. It's the way we normally do it. And 2025 to you, what were some of the drivers?
Yeah, I think flipping the page on the calendar year is also a great time to always go back and say, okay, what happened in 2025? What worked, what didn't? And then look into the next year. And I think the core theme of 2025 was really this inflection point on the multi-year CapEx cycle that is really reviving the next industrial revolution. And this is all around artificial intelligence. And if you think about the last decade, these mega cap companies were very good at scaling out in a very asset-light business model through high gross margins, low fixed cost software. But now the game's changed. This is an arms race to the next best AI systems, all through physical capital expansion. So the entire economy is going to look very different over the next 10 years than it did over the last 10, and it's going to be very much more capital intensive. So we saw everything in the entire value chain really start to take off when it comes to semiconductors, cooling system, power units, cloud providers, everything. And build out figures in aggregate for 2025 will approach around $500 billion in terms of CapEx spend. And what was equally surprising over the course of the year was not only the magnitude, but just how quickly the goalpost just kept shifting out quarter and quarter, more and more spend. All the while. But we also got some very real concerns around debt financing and circularity. We saw Blue Owl this morning, which is one of the private lenders, walk away from an Oracle financing. And we also saw the spread for Oracle CDSs really expand over the last couple of quarters. So we saw a lot of these higher beta stocks in the space sell off starting in November. We're also starting to see a lot of that happening this morning too. So although this was the earmark year for AI, we're starting to turn the page and we're saying, okay, we need some ROI on this. We need to justify the CapEx spend. So there is some cracks in the system, but I think we're just getting started on building a lot of this, and it's going to be an incredibly exciting year next year.
And what, looking forward, let's talk CapEx first. Is there still room for that right now, or do people really want to start seeing some returns on it?
Yeah, I think there is still a little bit more in terms of room that we can run on that CapEx side. But 2026 to me is going to be this show me year that really sorts the AI winners from the AI losers. So we had 2025 was this year where a rising tide lifted all boats, but 2026 is again going to be that sorting year. And what I'm really focused on here is still the enablers of AI. So specifically, that's the companies that provide both the physical and digital layers that power these systems. And that is the picks and shovels plays, like the chips, memory, networking, infrastructure. And I still think we have room to run in these names. And if you look at NVIDIA, very much sold out still on their Blackwell, their most recent chip. And then if you look at a company like GE Vernova, they're sold out for years on their nat gas turbines. So all of these are critical bottlenecks in the ecosystem that I still think have room to run over the first half of this year. And I love investing in these bottlenecks because that usually means pricing power. But when you have to understand is that these don't last forever. And at some point in this technology cycle, the focus is going to shift from the enablers of this technology to the adopters. So those that are using these tools to increase efficiency. So AI is going to be implemented into workflows and lifting a lot of operating margins beyond just the tech-focused names. So industries are going to start to see benefit from this, are pharma through drug discovery, maybe even biotech through genome sequencing. So these are some examples of the great adopters. But what I still really like here are those that sit at the intersection of enabling and adopting. So for these companies, I look at Microsoft, Google, Amazon, and these are players that have full verticalization in the entire ecosystem from silicon to applications, and they capture the entire value chain and are actually all free cash flow positive for next year, even when baking in this heavy CapEx spend. So these guys have the underlying cash flow and cash on hand that can finance this build out if it turns into a winners take most market. And if they end up also just giving stuff away for free to crowd out the market, you can see that scenario happening as well. They're also the bigger adopters of this technology because they're all eating their own cooking. They're the lowest friction companies when it comes to implementing AI because they already have it ingrained in their DNA. The market is really recognizing this with Google's performance this year, but they left behind Amazon and Microsoft, which are underperforming the benchmark significantly. And I think those names could have some catch up here.
And does this feel like this could be the year that we see big winners and big losers?
Yes, absolutely. And in terms of those that loser category, I think we're starting to see some of that in real time. Because if you look at a company like Oracle, they have a significant amount of debt on their balance sheet, and then after their earnings, they fell a significant amount. But on top of that, they came out and they said, "Hey, look, we have 250 million in leases that we have to sort of start committing to before 2028. And that is not really shown as a debt on their balance sheet. So when you have some of these companies that are building and building, building, but taking on too much debt, that's when you start to see worrying in the overall ecosystem. So you can see in that price chart of Oracle how it really had that gangbuster result after they reported a metric called RPO, which is remaining performance obligations, which just means bookings in the sense of the software world. And they said they had a massive increase in their RPO, around $500 billion. A lot of that came from OpenAI. Now people are saying, well, OpenAI doesn't have an underlying free cash flow generative business. And although they can raise a lot of capital, and they could do so also in an IPO, people are starting to question where the financing is coming from. So what we need to see here are players that can finance a lot of this growth through either free cash flow or cash on hand to really capture that ecosystem without taking on too much risk.
And just a little bit outside of this, are there any other sectors? You mentioned healthcare with especially research. Any other sectors that are early users of this, adapters of AI, and are really starting to benefit from it, and they see next year, say, being an even better year for them?
Yeah, I think if you look at even some supply chain companies, so you have companies that are going in and they're integrating their entire inventory management systems, their entire supply chain management systems, and using these AI routing tools. So you saw companies go out and really print these amazing efficiencies in terms of using this technology for predictive logistics. So companies like this that are going in and they're adopting them in these early stages are very much beneficiaries of this. And we're also starting to see it in healthcare. When you kind of get to these systems that are going out and they're expediting a lot of these different drug processes through phase 1, phase 2, and even discovery, and then you get to biotechnology and some of this genome sequencing, you can see some really exciting applications of AI actually being implemented into workflows. Now, what this does is it increases operating leverage for a lot of these companies. We've seen CEOs and even say the quiet part out loud, and they're saying, hey, look, we're cutting headcount. And a lot of this is a function of employees becoming a lot more efficient on an individualized basis. If you look over the past kind of decade, revenue per employee for S&P 500 companies has been relatively flat to a little bit up. But since ChatGPT came out, if you look at kind of the revenue per employee and the S&P 500 companies, this is all starting to go almost parabolic in terms of the growth rate. So we're seeing accelerated growth rate in terms of revenue per employees here as everybody gets a lot more efficient. Now, this has a lot of implications when it comes to the labor market, because you're going to see the labor market starting to show some cracks as we got from the recent economic data. But and this is going to reorganize some of that. But you need to focus on these companies, I think, in the second half of this year that are going to be adopting this technology a lot more efficiently.
We're going to have to wrap it up there, Nicholas. Thank you for joining us. Appreciate it.
Great. Thanks so much for having me. Appreciate it.
Nicholas Mersch is portfolio manager at Purpose Investments.